Kindly note that the views and opinions shared in this video are those of the speaker and do not constitute advice given by Classic Private Wealth. Any advice given by Classic Private Wealth will be in writing in the form of a wealth management proposal. Classic Private Wealth is an authorized financial services provider.
In the discussion, I thought that I'd kick off by differing from Clem Sunter. Now, Clem is a highly respected person in the South African business environment, and he goes around working with scenarios. And what Clem would normally do is to identify 3 or 4 things that if you did them right, that would put you on a path to a good result, and a couple of things where if you did them wrong would put you on the path to a bad result. And then the conclusion pretty much is you're either going to have a great result or you're going to have a terrible result. But that's actually not how life works. Life is much more complicated than that, and actually what happens most of the time is that you get some things right and you get some things wrong and you muddle through. So you get a reasonable result, maybe a little bit skewed to the upside or the downside, but typically not a disaster, and typically also not the fantastic result that you would have hoped for. And I think that if we were to think about the years since the start of democracy in South Africa in 1994, we'd pretty much get there. We'd say it's not an unmitigated disaster. There are some good things along the way, but it certainly isn't the nirvana that many people thought it would be when the change happened. So what I thought we would do is have a look at South Africa and the growth in the South African economy, because the other thing, apart from the fact that most of the time you actually end up with something that you might call muddle through, the other thing that you have to say is that the best predictor of future behavior is past behavior. So let's have a bit of a look at the past and to see what the behavior of the South African economy has been in the past, and then that might actually give us some indication of what we're likely to see. Now, the first thing I wanted to kick off, not because it's the most important thing, but because it's the most topical thing, is to kick off with the behavior of the government deficit. So this is the difference between the income and the expenditure on a cash basis of the government. So that gives you a deficit, or in very rare circumstances, a surplus. So I started in 1971 because that's when the Reserve Bank make these things available on an easy basis, and it's long enough ago. And what you will see is that the surplus or the deficit on the budget fluctuates. So what you have to remember in this case is that a negative is a deficit. So most of the time we are in a negative, and therefore a bigger negative, meaning a downward trend in this graph, is bad news, and an upward trend in this graph is good news. So the 2 highlights on the good news side is, number one is the 1981 fiscal year, when we had eliminated any borrowing and government income was actually equal to government expenditure. Now, those of you with long memories will remember that this was the year in which the gold price peaked, and South Africa at the time was still by far the world's biggest gold producer. Now, for those of you who live in the past, South Africa is now no longer among the top 3 gold producers in the world, but at that time we were by far the largest, and the largest contributor to government coffers was tax on gold mines. So we got a massive amount of tax in from gold mines, and that's why we eliminated the deficit in that one year. Unfortunately, the high gold price did not persist, and therefore we went back into deficit. The other highlight is then the 2006 and 2007 tax years or fiscal years. And what you see there is that the government actually had a small surplus in those 2 years. So this is the basis of Trevor Manuel's fame as a responsible Minister of Finance. You can see that for 2 years, we actually had surpluses on the government finances. And then in 2008, with the credit crunch, that turned into a deficit of slightly more than 4%, and we've been hovering between 4 and 5% deficit since. Now, the bad news on this is that what Tito Mboweni announced this week is that this deficit for the current fiscal year is now projected to be 14%. So you can see that that literally takes the deficit off the charts. So we've never in this period had a situation where we actually had anything like the deficit that we've seen. But the one thing that I would like to point out here is that the reason for the small deficit, both in 1981 and in 2006, 2007, was very strong economic growth. So strong economic growth is something that stimulates the tax income of the government, and it also removes some demands from the government, so such as payment to unemployed people and vulnerable people, etc. Those demands for payment is always larger whenever growth is slow. So what you can see here is that the biggest deficit we ever had was in the 1992 fiscal year. And the main reason for that is the country was in a deep recession due to the very high interest rates that was necessary to bring inflation under control. So it reminds me of the joke that Chris Stals used to tell. So Chris Stals put interest rates up to very, very high levels. And his comment on this was that everybody knew what needed to be done. Someone just had to do it. So it wasn't rocket science that you needed to put interest rates up and keep them high, and that you would then bring inflation under control, although many people doubted that. But the old joke among economists is that the difference between a recession and a depression is that in a recession, your neighbor loses his job, but in a depression, you lose your job. So the joke going around at the time was, what happens if Chris Stals loses his job? That's called an upswing, because then we might get lower interest rates. But the interesting thing here then is that the budget deficit to a very large extent is the result of growth or the lack thereof in the economy. And what we're seeing is the blowout to 14% that we are about to see in this deficit is very much the consequence of a very bad outcome for growth in the economy, because we've actually, throughout the second quarter, we basically brought the large part of the economy to a halt consciously in order to stop the spread of the coronavirus. And therefore, it should be no surprise that there was a very large shrinkage in the economy. I see that Tito Mboweni is saying that the economy will shrink by 7% this year. We think that's probably an underestimate. The economy is likely to shrink a little bit more than 10%. So even the 14% that's projected might be a little bit too conservative. We might actually see something more like 16 or 17% deficit. Now, obviously, if you accumulate these deficits, you actually get to the government debt. So let's just have a look at what has happened to the government debt over time. And here you will see this, in this case, a large number is bad because the more debt that we have, the worse it is. And what we're doing here is we are calculating the government debt as a percentage of GDP, in the same way that we calculate the deficit as a percentage of GDP, because it relates to how large the debt is relative to the economy that you're working with. So what you can see here is that there was an initial period through the 1970s when the government debt was actually fairly high, but it dropped quite precipitously around about 1981 because of the fact that we had quite high inflation and no government deficit initially, so that brought the government debt as a percentage of GDP down. And then we went into the period after 1984 when we had a debt standstill, where in order to make sure that there was enough foreign exchange to repay debt, not government debt, by the way, private sector debt, to foreign creditors, the government actually kept its deficit under control, but they kept it under control by investing very little. So government debt was quite small, but government assets also were deteriorating during that period, the period 81 to 91. And then you see in 91, because of the very large deficits associated with the deep recession, you see the deficit increasing very quickly. Then as growth returned under the new dispensation, there was a small decrease. And then you see from 2001 onwards, a large reduction in the government debt. So this is now the period of Trevor Manuel's, where Trevor Manuel was Minister of Finance. So he introduced some serious discipline, but also it was a period of fast growth for the South African economy. And that allowed us to bring the government debt down to 25% of GDP. So you can see that if you look at the period 1996 to 2006, 10 years of reasonable prosperity, the government debt reduced by about 15% of GDP. So the disaster that we see this year, of roughly, there's someone who is not.
I think that's Chris. Chris, if you'd mute yourself.
They're right.
Okay. So what you see is that if we have a 14% deficit this year, that 10 years of reasonable prosperity will allow us to actually get rid of the debt that we're making in the process. So just to give you an idea of the size of the current disaster. So what we're seeing here is that by the end of the 2019 fiscal year, we were already sitting at roughly 55% of GDP as debt, which is larger than we've had since the early 1970s. And we are now projected to reach roughly 80% by the end of the next fiscal year. So for the moment, we are projected to turn around at about 80%. Our view is that the economy is likely to remain weak for a year or two after that, so the deficit is likely to remain large, and that we are likely to see this deficit actually balloon to about 100% of GDP before it turns around. So the real question is that disaster something that we can deal with, or is this something that triggers a doom loop, meaning that we actually go into a position where the government debt just becomes larger and larger? Now, economists have for a long time explained something called a debt trap, And the debt trap really has to do with the fact that you get to a point where if you have very large deficits and you have very large debt, the interest on your debt may grow faster than your GDP. So effectively, if the interest rate on your debt or the interest payment on your debt grows at a faster rate than your nominal GDP, it basically grows to infinity, which means that effectively at some point you have to renege on your government debt, or you have to inflate the economy to the extent that you get a better result in terms of government debt versus GDP. What we would say is a very serious situation, but not necessarily something that we would be unable to manage. So let's just actually quickly go and have a look at growth in the South African economy, because the key to this whole thing is actually growth. So what we would say is government deficits are large when we have low growth, and government deficits are small, and we may even have a surplus when the economy is growing quickly. So the future for government debt and the government deficit, the most important driver of whether this is and stays a problem is the growth in the South African economy. So let's just have a look at what makes the South African economy grow and what growth in the South African economy actually looks like. So once again, we've got the period from 1971 onwards, and we've got growth in the South African economy. In this case, the larger the number is, the better, and anything below the zero line is a recession. I well remember that I started work at the Reserve Bank at the beginning of 1982, so you can see that was the first recession on this graph during 1982. And Gerard de Kock was the president of the Reserve Bank, or the governor of the Reserve Bank at that point. And his first comment was, South Africa doesn't actually have recessions. We have periods of slower growth and periods of faster growth, but we don't actually go into recessions. Now you can see that those were famous last words, because we were going into the first recession for about 50 years as he was speaking. So you can see that in a bad recession in South Africa, you actually get a contraction in the economy of about 2%. So there you have 2% in 1981, which was the global recession triggered by the American anti-inflation drive led by Paul Volcker. And then you see in 1991 another recession, this one triggered by our own anti-inflation drive under Chris Stals. And then you see 2008, the credit crunch, slightly less severe actually. To some extent that was dampened by the fact that we were preparing for the World Cup. So as Trevor Manuel said in Parliament at the time, other countries are looking for shovel-ready projects, but we are already shoveling. So we had quite serious capital projects on the go preparing for the World Cup. That's why we didn't have as severe a recession as a lot of other countries around the world. The other good thing there was we didn't have vulnerable banks like the rest of the world. So our banks actually came through that in a much better shape than other countries. But what you then see is a fairly quick bounce back after the 2011 or 2008 recession, but then growth actually reducing to the point where before the coronavirus problem started, we were actually back to 0% growth in the South African economy. So maybe let's just have a look at the periods of good growth and what caused them. So what you see is there's a period of fairly strong growth early in the 1970s, and then again late in the 1970s. And then you see a period of fairly strong growth from roughly 1996 to 2007. So a period of 10 years of fairly strong growth, only interrupted in 1998. So in 1998 we had, you might remember, was the emerging markets financial crisis, which also affected South Africa to some extent. So we had a dip in growth during that year. But apart from that, we basically, in this 50-year period that we're looking at, we only see about 10 years of fairly strong growth, consistent growth. So what you would say is, obviously, a large part of the problem was that we're seeing the last strained years of the apartheid regime on this graph. So a part of the low growth was caused by sanctions and by the internal problems caused by politics. And then we see 10 years after the abolition of apartheid actually quite strong growth. But what you then have to explain is, why is growth so low at the moment? And effectively, if you go back to it, the only way that the South African economy grows, and this goes for all of the growth incidents on this graph, is that we have a period in which the international community becomes quite positive about South Africa, mostly on the back of increased exports of commodities. So originally through the 1970s, the gold price specifically, but towards the later period of this, a more general commodity-orientated boom. And what typically happens there is, it's not the actual exports of the commodities we produce which produces the boom. It's the fact that foreigners become more positive about South Africa, and that money flows into South Africa, which strengthens the exchange rate, which in turn pushes down inflation, which in turn allows the Reserve Bank to drop interest rates, which then causes a consumption and investment boom in South Africa. So growth in South Africa has never really been an export-driven phenomenon. It's a confidence-driven phenomenon rather than an export-driven phenomenon. But exports play a large part in generating that initial confidence. Growth in South Africa has never been the same as the kind of growth that we've seen in the high-growing countries around the world over the last 50 years. Let's just say Taiwan, Malaysia, China, all of those places, Singapore, South Korea, and so on, countries that basically pulled themselves up by their bootstraps over a period of time. Those countries focused on building an export engine driven by growing productivity over time of the workers. We've seen none of this in South Africa. So if we look at the lack of growth that we are seeing in the South African economy, remember now this is before the coronavirus struck. Why was growth so low? And there's a twofold answer. The one is that commodity prices were low, and therefore that actually fed through into a lack of confidence in the South African economy. But the second thing is, we actually see the gradual result of the state capture project, because the state capture project gradually reduced the confidence of the private sector in South Africa to the extent that they stopped investing, and therefore it actually was a self-compounding lack of investment and lack of confidence, lack of consumer spending as well, eventually. One of the interesting features during this period is actually, despite the weaker growth, the Reserve Bank did not lower interest rates, because they were saying that actually they had an inflation target and they stuck to the inflation target. And in fact, they were, over the last couple of years, trying to reduce the inflation expectations from 6%, which was the top end of the target range, to about 4.5%, which is the middle of the range. So they changed their mind about where in the 3 to 6% range they needed to be. At the moment, we're seeing inflation at the bottom edge of that range at 3%, and likely to actually fall further. But what we don't see on this graph is the effect of the coronavirus. So what we're likely to see now on this graph is a minus roughly 10% over the next year, and then a fairly quick bounce back, because from that very low level, you will see growth returning, but actually the activity level in the economy will still be below what it used to be. If we now move on to what actually drives this growth, what you can see, this next graph that you should be seeing gross fixed capital formation in the South African economy. And what you see is that during the periods where we saw some strong growth in the South African economy, you also had strong capital formation, meaning investment into the South African economy. Remember now, this is driven by two forces. The one force is that lower interest rates and confidence in demand means that private sector companies invest into the South African economy, and then demand for more infrastructure means that the government sector follows with a lag. So in South Africa, we actually haven't seen government infrastructure creation driving economic growth. It basically lags because the government reacts to the demand for infrastructure rather than to be proactive in the South African economy. So what you see is that around about 1976, you have a collapse in investment in South Africa. That was driven by the rioting and internal resistance to the apartheid regime. So that was the low point, early on low point. Then you see in 1981, because of the very strong gold boom, there was very strong investment into the South African economy, which then collapses roughly by 1986. The 1986 collapse very much driven by the debt moratorium that came into place in 1984. So that's the result of sanctions. Then you see a bit of a bounce back from that. And then you see a fairly sustained period of high investment from roughly 1996 to 2006, only interrupted in 1998 by the emerging markets crisis. So actually, what drives growth in the South African economy is investment. Now, that investment is the combined investment of the South African government and South African state-owned enterprises, as well as the investment by the private sector. But as you can see, over the last couple of years, that growth in investment has been very close to zero. So whereas you haven't seen a collapse in investment spending, what you have seen is very little growth in investment spending. So that has to do with business confidence in South Africa. So what we would say is the main driver of low growth in the South African economy over the last couple of years has been low business confidence, driven by the whole state capture project. So business in South Africa has come to the conclusion that it's not really very welcome in South Africa, and that they will not have a fair chance to compete because they will be forced to sell to some Gupta-related company the moment they become really profitable. and therefore investment into the South African economy has been very low. So with that, the basic conclusion about the South African situation is the thing we need to worry about if we're thinking about government finances is not what kind of taxes can we levy in order to get government income up, or where can we cut government expenditure, although we could probably cut government expenditure quite a bit by stopping the subsidies to state-owned enterprises. But the main issue is, how do we restore business confidence and consumer confidence to the extent that we can return to growth in the South African economy, and that growth in the South African economy will then actually enable us to run small deficits or even surpluses and to reduce government debt as a percentage of GDP over time. So maybe let me quickly just spend a little bit of time on how governments go about reducing government debt, because this is not only a South African issue, this is going to be a global issue. The collapse in this income and the massive extra expenditure we're seeing in South Africa that will lead to our 14% deficit over the next year is being replicated around the world. In fact, a lot of countries, those deficits are significantly larger. So how do governments go about reducing debt once a crisis has driven them to a much higher level of debt than they desire? So it's interesting that a part of what governments do after an incident where they have acquired a large amount of debt. So let's just think about the United States government having made a large amount of debt to get through the Second World War. It took them roughly 30 years after the Second World War to get debt down to levels that they wanted. So by around about 1980, debt was very much under control in the US. But essentially what they had is a period of 20 to 30 years in which real interest rates stayed fairly low in order for the government not to pay inordinate amounts of interest on its debt, and that enabled them to actually bring debt down. The other thing that governments do is they stimulate nominal growth in their economies, meaning they actually allow inflation to be a little bit higher so that the economy grows in nominal terms a little bit faster so that the value of the debt is lower. So there's a real a risk that government bondholders will end up in the long run with low real returns, not only on South African government debt, but on government debt around the world, as governments try to reduce their debt over the next 10 to 20 years, because this is an incident that will stay with us as long as 10 to 20 years. The next thing I wanted to point out is that we've actually had a significant structural change in the South African economy over the last 25 years. And I wanted to just point out some employment trends, which actually also gives us a good idea of what the current situation in South Africa is and what the prospects will be. So if you look at the total employment in the public sector over the period, Oscar?
Sorry, I think it might be Greg or someone is there. Will you please mute?
So yes. sorry about that. We don't mind people taking part in the conversation, but if you're not muted, then unfortunately it impinges on this on the sound. So if you look at the employment by the public sector in South Africa, it's interesting that you see basically three periods there. The first period is a period of strong growth from 1970 to about 1985. So the economy was growing at a reasonable rate, but there was also a lot more demands being made of the government. So there were two strong trends that meant that the government employed more people through the 1970s and 80s. The one was that they were actually the rise of the so-called TBVC countries, Transkei, Venda, etc., the homelands. So remember that those were also governments in the South African context, and they employed a lot of people. And also there was a great expansion of education in this period, so a lot more teachers were hired. And then this hiring spree came under pressure after 1984 as the government needed to cut back in order to comply with what was happening in terms of the debt moratorium situation. Government employment stabilized. And then you see something very interesting happening. After 1995, you actually see a substantial shrinkage in the employment of the public sector, which is something that is unusual in the modern economy. And what we see there is actually two things. The one is a major shrinkage in the army, because we were no longer fighting a border war. So obviously the border war also meant that we employed a lot more soldiers in the army. So I guess that was the third thing that pushed employment up through the 1970s. So there was a major shrinkage there, but also all of these ex-homelands, these civil services were disbanded and incorporated into the South African civil service, and therefore that actually saw a shrinkage in the employment in the public sector. So the interesting thing is that during the period of strong economic growth from 1996 to 2006, the growth didn't happen because of government spending. The growth happened because of spending in the private sector, and the government sector actually shrunk during that period. But then you see from 2005 onwards, quite a large expansion again of the civil service. And this really has to do with the populist project that came into being during the Zuma years, although the initial stages of the growth really preceded that. But this is growth in the number of civil servants and the number of people employed by the state-owned enterprises. So you see, for instance, a place like Eskom expanding its workforce, SAA expanding its workforce, etc. So a bit of a populist project where people got employed, but not necessarily gainfully so. If you were to look at the private sector during the same period, you actually see significant growth in private sector employment continuing until about 1995, then a period of stability in employment, and then actually flat behavior from about 2005 onwards in private sector employment. So what you would say is that from 2005 onwards, even though there was no additional work being done, no additional, let's say, the tax base was not expanding because there weren't additional people being hired in the private sector, but the public sector continued to expand. So what you will see is that the expansion in government debt goes hand in hand with an expansion in government employment. If we go back to the government employment graph for a moment, you will see that there's a tempering in that graph. So the expansion in employment stops around 2014, because as the government's budgets start to come under pressure, the ability to just employ more and more people has come under pressure, and we actually see a small inkling of a downward trend. And we do need that downward trend to continue, otherwise we won't get government debt under control. But I want to point out something else that is very interesting in the South African economy, and that has to do with remuneration per worker. So another part of this populist project, but it's actually something that comes long before the Zuma years. It is the fact that the remuneration per employee in the South African civil service has been going up in real terms significantly from 1990 onwards. So it's interesting that from 1970 to 1990, for 20 years, the average remuneration of workers in the civil service actually shrinks. And then from 1990 onwards, but strongly so from 1995, you actually see workers being paid more. So from roughly 60 in 1990 to roughly 110, close to a doubling in real terms of the remuneration of public sector workers. But the interesting thing is, this is not only the new government pandering to their support base in the civil service. The same thing happens in the private sector. So if we can go to the private sector remuneration, you actually see something very similar. So you see that real wages in the economy didn't go up much from 1970 to roughly 1990, 1995. And then you have a large increase in the remuneration per worker. And this is in real terms, meaning after inflation. So something happened in the mid-1990s that pushed wages up in South Africa. And the first thing that you would say is, if you see a real wage rise of this size, both in the public and the private sector, you would say, but actually, there needs to be a commensurate rise in productivity. So if we go to the next graph where we get to measured productivity of workers, you see that productivity fell gradually between 1970 and 1995, and then rapidly accelerated and roughly doubled from 1995 to 2015. So what you would say is that employed workers in the South African economy is roughly double, their productivity has roughly doubled over the last 30 years. So something happened that made South African workers a lot more productive. Now, remember now that productivity in labor productivity is measured by the amount of output per employee. And what happened in the mid-1990s, unfortunately, is not that South African workers suddenly became a lot more productive. What actually happened is that the employment terms changed because the labor law changed in the mid-1990s. So the author of those new labor laws was Tito Mboweni. And as usual, he was doing more than he should. And he gave us some of the most restrictive labor practices in the world. So basically, labor became a lot more expensive after 1995. And what companies did is they basically got rid of all low-wage workers because it just didn't make sense to employ low-wage workers anymore. And they replaced many of those workers with machines. So instead of having 10 people with brooms, you would have one person with a machine that replaces the 10 brooms. And that person on a measured basis would now be a lot more productive. There's a lot more production from that little truck that sweeps up the floor than with the one worker. So the per worker output goes up a lot, but actually total production doesn't go up a lot. And actually also value for money in terms of workers doesn't go up a lot. So effectively, what you see is a great deal of the South African economy becoming a great deal more capital intensive. And that pushes wages for people with jobs up. So what you will also see is that actually unemployment goes up, structural unemployment goes up significantly after 1995. So effectively what we've got in South Africa is we've got an economy that is being run on behalf of the insiders, and where the vulnerable outsiders are being left to their own devices. So what we see in South Africa is actually who are the insiders? The insiders are the civil servants who belong to ANC aligned unions, and those people are being mollycoddled, and they are getting very high remuneration. They are not being retrenched. And what you see in this whole crisis is that the private sector, and especially small business, has been devastated by the whole coronavirus incident. But actually, if you look at the civil servants and the politicians, not one of them has even been inconvenienced, in the sense that they're all still getting their full salaries. And you also see the feedback we're getting about people going back to work is that small businesses are desperate to get back to work after the lockdown, but civil servants are very reluctant to go back to work because they believe that it's risky to go back to work. So their perception of risk, because of the fact that the risk-reward trade-off for them is so much different from the risk-reward trade-off for small business people, that there's a great reluctance to go back to work in the civil service, where there's a great alacrity to get back to work in the private sector, because the private sector people are desperate to get back because they can't make a living without it. So unfortunately, what this means going forward, what we've got to now ask ourselves is, what's the future once we've looked at this? And what we have to say is, the first question we need to ask ourselves is, will it be possible for the government to bring government debt back under control? And the answer is, they will if there is a return to reasonable growth over a medium term. Meaning by 2030, 10 years from now, we need to look back and say there's been at least 7 of the 10 years where growth has been reasonably strong. So what is reasonably strong in the South African context? Let's just say 2% or more, with actually the average being probably 3%. So we need 2 to 3% real growth in the economy in order for the government debt to be able to start reducing and for the government to bring government debt under control. So that would be the first thing that we would say, is it's not so much about anything other than actually the growth in the economy. So what will drive growth in the South African economy? And there are 2 things. The one is internal and the other is external. So the main thing we need to drive growth is we need a significant increase in investment into the South African economy.
Wikus, I'm sorry. I don't know if anyone else was, but I was locked out there for about a minute. Could you just repeat what you said for about a minute ago? Okay.
So effectively, if we go back to growth in the South African economy, what will drive growth in the South African economy? Investment. We need investment to be significantly larger than it was in the past, and we need a fast growth rate in investment. Now, one of the things that you will hear is that the government is already starting to talk about a large increase in government investment. Now, the problem with this large increase in government investment is that the government's ability to deliver on these investment projects is under suspicion. But as long as they are prepared to do this in terms of public-private partnerships, then there's no reason to think that there can't be an increase in investment from the government. So the president has talked about investment in infrastructure being the flywheel for the South African economy. And I think that is right. So what you need is you need to restore demand in the economy after the shutdown, and investing into infrastructure projects. Although you will be borrowing money, you also have an asset which you can later privatize or get an income stream from. So a significant acceleration in government investment would be necessary, but that would not be sufficient. What we actually need is a significant increase in investment by the private sector. And the private sector investment will be driven by business confidence. So what we actually need in order to fix everything in the South African economy is a restoration of the confidence of the private sector in South Africa. So business confidence needs to be restored. So what has undermined business confidence? What has undermined business confidence is a combination of corruption and government inefficiency and bad administration, if you like. So what you need to do is you need to be very clear that the economy or that corruption in the South African economy will not be tolerated. Now, again, what you need is, if you are going to publicize corruption in the government, what you need is to also be seen immediately to be acting on that corruption. So what I would say is the way that the Zondo Commission has been handled, where people have been giving evidence about massive corruption, and there's been no action whatsoever taken to pursue the people responsible for that corruption, is actually a major cause of the lack of business confidence. So what needs to happen is that the government needs to clearly signal that it is on top of the corruption issue. That's point number one. Point number two is you need to fix the state-owned enterprises. So first of all, you need to fix electricity production. So the Eskom disaster needs to be reversed. Now, that's actually a nice opportunity to increase investment, because we need to increase investment in electricity production, hopefully green electricity production. But you need to fix that. And then you need to actually demonstrate competence on that side. So internally, you need to turn things around. Then secondly, you actually need an external stimulus. And luckily, we are very likely to receive that external stimulus over the next 5 years. So South Africa is not the only country in the world that has been announcing large infrastructure projects as the way to get out of this hole. Every country in the world is talking about infrastructure projects, including the United States. Obviously, what happens with those large infrastructure projects is that it takes a while for those projects to get going. So we probably won't see a large amount of that in the next year. But for instance, in Britain, they are now trying to accelerate infrastructure investment. Boris Johnson calls it Project Speed. Now, There are people that say that when he gives his speeches, he is on speed. But apart from that, he's trying to accelerate all of the existing infrastructure projects in order to get some money back into the economy and some confidence back into the economy. So what we're likely to see is that all over the world, in virtually every country around the world, there will be a large emphasis on building infrastructure. Now, if you look at the South African situation, you see that the period from 1996 to 2006, the period of good growth that we can identify in the South African economy, happens to be the period when there was a large amount of demand for South African produced commodities from China, because of the fact that China was basically building a city every year in order to accommodate the very fast economic growth that they were having. So this time around, it won't be one country, it will be basically a worldwide phenomenon, but we are very likely to go back to something that you would again be able to call a super cycle in commodities, a ramp up of demand for commodities that will continue for multiple years. Now, that is again the basis of something that would really stimulate exports for South Africa, but the important part of that is not really the exports themselves, it's the confidence that those exports generate in the South African economy that then leads to a stronger currency, lower interest rates, and higher investment by the South African private sector. So what you need is both of those things to happen, and then you can have a very good result. So what are the prospects then if we were to take all of these things together? It says there is a path to quite a good outcome for South Africa, but it's very unlikely that we do everything we need to do to get onto that path, and that we are actually a fantastic economy between 5 and 10 years from now, and that we generate growth and create jobs across our economy. So let's just go back to the question of saying past behavior is the best predictor of future behavior. So the first thing we would say is there's no reason to believe that the current president and his supporters are in any way corrupt or likely to tolerate corruption. So the first thing we should say is we are likely to see quite strong action against corruption in general over the next 5 years, which will be a very big positive for business confidence. The fact that we're seeing some of the VBS people being arrested and actually on trial is a very good thing. We're also actually likely to see the ex-president go on trial in the next couple of months. So if there's a guilty verdict there, that would also be a major boost to the anti-corruption portion. So that part, I think we should say likely to work in favor of the economy. The second thing, but what you have to say is that doesn't immediately translate into new investments. It creates a background in which in a couple of years' time, new investments might flourish. The second thing that we see is we've got to remember that the current president cut his teeth as a unionist. So the question is, will the unions be brought to heel, and will the high wages be brought under control, and will there be jobs created at a lower level for more masses of people? And the answer there is probably not. So what you're likely to see is that the influence of the unions will stay very strong, and that will mean that it's very unlikely that wages will be reduced in any meaningful way in the civil service. or in fact across the private sector. So of course the private sector, being in crisis, has reduced costs significantly, and they are likely to keep costs under control significantly, and obviously that to some extent that will spread into the civil service. But what we will say is unlikely that civil service wages will come under control, and that would contribute to reducing the government deficit. What is likely to happen is that they will allow by attrition some civil servant, the number of civil servants to be reduced. So we're likely to see a reduction in the number of civil servants eventually. And we are also likely to see, through financial pressures that have now built up, that there will be a restructuring of some of the state-owned enterprises, and that the number of people employed in those state-owned enterprises will go down significantly. So SAA, for instance, rather than having no retrenchments, will retrench 80% of the people in the business, and they will then re-employ some people as they ramp up. In the same way, it's likely that when Eskom gets restructured, over time, the total number of people employed by Eskom will be significantly reduced, but not at lower wages. The people employed will still be paid quite high wages. The upshot of this is that there will be most likely a gradual return of confidence in the private sector, unless we actually get actions from the government that reduces the confidence of the private sector. So what is likely to happen in terms of the of government actions that will reduce private sector confidence? So one of the contributing factors to the lack of confidence in the private sector is an overemphasis on BEE. So the whole idea that you need black partners and that you need to give a part of your business in some way to local partners, etc., that has been a big disincentive to foreign investors, and it's actually also a big disincentive to some white business people. So actually, what happens is an overemphasis on BEE could be very detrimental to business confidence. The other thing that could undermine business confidence and could undermine, in fact, the tax base is that if the government turns to very high taxes of some sort in order to fix the government debt problem. And there, what we actually need to understand about government finances is that the real driver of government income is income tax and VAT. So VAT, in fact, is the largest contributor to government revenue. So the VAT rate is actually the most important driver of income. And both on income taxes and on VAT, we have as high rates as is probably affordable for an economy that is at our level of development. So there's a very good reason why Tito Mboweni over the last 2 years has refused to put taxes up, and that's because actually taxes are as high as is effective. Interestingly enough, things like estate duty and capital taxes on capital actually bring in very little money for the South African fiscus, and actually for the fiscus anywhere else in the world. So any massive income that you're trying to raise from taxes on capital, I see that a solidarity tax is much discussed at this point. We're also having discussions about estate duty going up, if you believe Pierre de Vos, to 100%. All of those things will be massively detrimental to business confidence. And what is likely to happen is that the people that you want to tax are actually mobile, and they will remove themselves from your tax base if you tax them too strongly. So that has never, unfortunately, meant that the government doesn't do those things that has actually got negative implications. So what we're likely to see in terms of the muddle through scenario is that we are likely to see a combination of some positive things and some negative things. So in terms of the positive things, it's likely that interest rates, because of the fact that inflation expectations are well contained, interest rates are likely to stay reasonably low. In fact, short-term interest rates have been brought down considerably and are likely even to fall further. So inflation and interest rates will stay low. That is a good environment for investment in the South African economy. The prices of the commodities we export are likely to start rising reasonably soon after the coronavirus incident ends, which should be towards the first half of next year. We'll see commodity prices starting to go up, and it will gradually go up for another 5 years. So that will drive investment into the South African mining sector. The mining sector are likely to experience less state capture intervention, and therefore there should be more investment into the mining sector. That will drive some growth, and there will be some positive spin-offs from that. However, at the same time, we are likely to see that the government itself will also not, first of all, reduce headcount and reduce salaries in the civil service by anything like the amounts they would have needed, which would have also been very supportive of confidence. And at the same time, we'll also see as a positive again, significant investment by the government into various infrastructure projects. But then we're also likely to see that some of those infrastructure projects are likely to not come on stream as expected, because in fact, what we've seen over the last 10 to 15 years is capacity in the government sector has come under great strain, and therefore it's unlikely that all projects that they go into will necessarily go smoothly. So what I would say to you today is my own conclusion, looking at the prospects for the South African economy, is it's likely that after about 2 years of quite slow growth, so the first year about a -10, and then I guess about a +5 the next year, so we end up being 5% short in year 2 after the coronavirus, then the economy is likely to return to where it was before the coronavirus by about 2022 to 2023, and then have about 2 to 3% growth, most likely for another about 4 years, which I guess you would call a reasonably good outcome from where we are currently. So what I would say is it's not necessary to be despondent. The prospects for the South African economy is not necessarily terrible, but at the same time, we mustn't underestimate the negative impact that the coronavirus has had. But what I would say is it's more important how the government reacts to the coronavirus than how much actual damage there is from the coronavirus. Because in the end, what will drive growth is the question of whether they can restore eventually private sector investment confidence in the South African economy. If they can do that, then there will be reasonable to good outcomes. If they can't do that, even without the coronavirus, there would have been bad outcomes for the South African government. in all of this, what I would say is there's nothing that tells me that our basic approach to the South African economy and to investment in South Africa has to change. So our basic advice to our clients over the last 5 years has been the South African economy is still the place where you as a South African can make the most money. There will be opportunities for wide awake entrepreneurs to make a lot of money in the South African economy over the next 5 years. Any problems that exist are also opportunities to make money. So that I don't think will go away. The general environment in which it's possible to make money, if you are flexible and entrepreneurial, that will continue to be the case. At the same time, there's nothing that says that there will be such fantastic growth in the South African economy that you should now be allocating the bulk of your wealth preservation money also to the South African economy. The South African economy will be vulnerable, and there are a lot of things that can go wrong in this situation. So even though it's most likely that we will at least muddle through, there are paths to a disastrous outcome that you could easily imagine in this situation. And therefore, it behoves us to invest a significant portion of our money outside of South Africa in order to make sure that we don't give away the gains we've had in our financial position. So what I would say to you is, I think that the basic approach of saying South Africa, for South Africans, South Africa is a good place to make money, but not necessarily a reliable place to preserve money, is likely to hold good over the next 10 years. Questions and comments?
Well, thanks, Wikus. I think that was amazing and very instructive. Has anybody got, now that Keith doesn't seem to be here, maybe Greg will take his place and ask you a question.
Greg, are you going to volunteer?
He's obviously fallen asleep. Just
I'm still here. No, thank you. It was a very interesting talk. Thank you.
Okay, great.
Let me think about while you talk.
Okay. For people who have come on a little bit later, like Neil, we are recording the talk, so we'll be sending it all to you once it's been collated, and we'll send it all to you for future reference. I know that I had a couple of little breaks in the talk from a signal point of view, so I'll be looking at the recording from that point of view as well. So if there's no one else, and by the way, when you get the recording, we're always trying to improve what we're doing. Please will you make comments, and if you want any specific advice on what, the way forward, that's our business. It's advisory. We're not asset managers, but we do give advice, and we have been doing it for quite a few people for quite a long time. So if there are no more comments, I just thank Wikus again. So there's someone else. Yes, carry on.
It's Clive. Wikus, can you comment on the IMF? Well, some of the money that Mboweni wants to borrow apparently is from the IMF with very little restrictions. But if you read R.W. Johnson's book over the last two, over the years, How Long Will South Africa Survive? He always said, we're going to have to do this IMF thing. And from what I've read, it's not necessarily a bad thing, because they put restrictions on how we govern. And the ANC has always been skeptical or didn't want to be governed with restrictions. if they did borrow from the IMF. Can you just make a quick comment on the IMF loan?
If we could get the IMF restrictions without getting the IMF money, that would be great. So the thing is that the IMF would normally prescribe quite conventional things, like you need to keep your deficit under control. You can't have too high wages in the civil service, etc., which is exactly the reason why the government doesn't want those IMF restrictions, because essentially what they do is they force you back into the more conservative mold. Now, the first choice always is for the government itself to be so responsible that they don't need to borrow from the IMF and they don't need the IMF's restrictions. So if you look at what Trevor Manuel did throughout his term, he did exactly what the IMF would have prescribed, and therefore he got the right results. So actually having those restrictions from an economic point of view is not a bad thing, but it's much better if you voluntarily do the right thing. In this instance, the reason why we need to borrow from the IMF is not really that our own irresponsibility that has caught up with us. It's the coronavirus crisis, which is why they are prepared to make some money available to us without those normal restrictions. And what you have to say, one of the good things in the South African situation is that we owe very little money to offshore entities. So even the monies that we are now likely to borrow from the IMF and the BRICS Bank and so on, they are modest in the overall South African situation. So the bulk of the money that the South African government has borrowed, the bulk of that government debt, is actually sourced in the local market and done by local savings, which means that we are much less vulnerable to a currency crisis than most other emerging markets. So if you look at someone like Argentina or Brazil, they borrow a much larger portion of the deficits from offshore, and therefore that makes them much more vulnerable to currency crisis. So in fact, the South African foreign borrowings is not really a big issue, and that's also why the IMF is unlikely to impose the normal strictures, because their normal strictures are actually aimed at dealing with the fact that you owe too much money to foreigners. And actually, that's not part of our problem.
Wikus, hi.
Thank you, Wikus.
It is great here now. I'll ask a question off the back of that. My concern with that situation is that there's a huge incentive to inflate the debt away. And I know that in the short term, maybe because of weak markets, that's less likely to happen. But I think that in the longer term, high inflation as a way of managing that local currency debt would be a concern. What's your view on that? And in terms of, I mean, obviously South Africans can then try and take money offshore, but do you think that's a real risk for us?
Yes, it's always a real risk, and it's actually a real risk not only for South Africans but around the world. So effectively, one of the things that happened, if you look at what happened after the Second World War in the United States, is there was actually quite a long period during which they made sure that they didn't have too low inflation in order to make sure that they could get rid of the debt eventually. So negative real interest rates on debt is one way for the government to reduce its net debt over time. So there is a real risk there, and it will be, I guess, in terms of the debate within the ANC, there's the debate about the independence of the central bank, because the central bank has been very strong on keeping to their inflation targets. And one of the real successes in the South African situation over the last 10 years is that in spite of all the negative things that happened in the public sector, we stuck to our inflation targets, and inflation actually came down over that period. So the track record on that is good, but yes, the incentive will be there, and there will always be the push from the more populist part of the ANC to actually be less restrictive on the monetary side, and that eventually will mean that inflation will be higher rather than lower in South Africa, and that there will also be some risk to the currency's value. So yes, it does increase that risk. For the moment, you would say that the institutional arrangements, an independent central bank with inflation targeting, makes it unlikely in the short term, but in the long run, the risk is larger than it was in the past.
So just
Thanks, Wikus.
2 questions from my side.
Wikus, can I ask you one question? Given the massive capital projects, what do you think, what's your view on the oil price?
My own view on the oil price is that you have to go with Sheikh Yamani, who was actually the originator of OPEC. He said that the age of oil will come to an end. The Stone Age did not come to an end because of a lack of stones, and the oil age will also not come to an end because of a lack of oil. So it's likely that we will make a transition to a post-oil economy long before oil runs out. And we need to make that soon, otherwise we'll get some very negative outcomes on the climate side. So actually, if you think medium term about oil, there's a very negative future for oil from this point forward, but that doesn't necessarily impact the short term. In the short term, my own view is that the Saudis are very, very worried about ending up with a large amount of unsold oil when the demand for oil eventually dries up. And therefore, they don't want the price of oil to be too high. And they also don't want other people to be producing too much oil. So I think that the recent spat ostensibly between the Saudis and the Russians about cutting back on oil production was actually all about removing American shale production. And for them, shale production starts ramping up when you get an oil price that is significantly stronger than $40 per barrel. So we're currently sitting just about at $40 per barrel. And I don't think the Saudis want the oil price to go much higher than that. So my own view is that we are likely to see an increase in Saudi production again as soon as the oil price starts exceeding $40 a barrel for any length of time. So we're likely to see oil fluctuating between about $35 and $50 an ounce of a barrel, and not much more. I think that structurally the oil price is going to be significantly lower going forward. And remember now that oil is not necessarily the component that goes into all of these infrastructure projects. A lot of those infrastructure projects, in fact, will hopefully be green energy projects.
Okay. Thanks.
Wikus, I have one more. We've had quite a few questions about the exchange rate and whether it's an opportune time to send money offshore now. Perhaps you can make a comment on that and how we are handling it.
So for us, for most of our existing clients, they got significant money out of the country before the exchange rate became so weak. The first thing that we would say is that, in fact, South Africa is not the country printing massive amounts of its own currency at this point. So there's massive printing of dollars, there's massive printing of euros, there's massive printing of yen, but not massive printing of rands. So that in the end means that the rand should actually become stronger rather than weaker. So we don't think that these are the kind of circumstances that will permanently make the rand weaker. So we think the rand goes back to the range that it was in beforehand. The average, long-term average for the rand sits at about 14 Rand 60. So we think that we are likely to see 14 Rand 60 again at some point. Not necessarily in the short run. In the short run, we think that we'll go back to a range of 15 to 16 fairly soon, rather than the 17 and a bit where it is now. So we think that the rand is too weak, and it's really a question of the liquidity constraints on emerging markets that came with the whole crisis. The way that we would normally deal with that is we would actually invest. If we had a new client who needed to take money offshore, we'd flow the money offshore, but we'd hedge it back through derivatives. And we would unhedge it when we got to measures where we believe the rand is at reasonable value. So we look at the standard deviation of the rand. So one standard deviation away from the 1460 is actually 1660. So effectively, we'd be hedging our currency bets until we get to 1660, and then we would gradually increase our exposure, and we would have full exposure once we got to about 1360. Again, what we would say is there are two things that are likely to make the rand stronger. The one is yield in the South African market is still fairly high, and that will attract money to South Africa in the short to medium term. And then eventually the rand will be a beneficiary of any commodities boom. So we might actually see quite a strong rand 2023, 2024, and going forward. So we don't actually think that the rand is that our attitude to the rand has been changed in a major way by this incident. For the moment, we think that South African government bonds on the long end actually offers very good value. And in fact, that will also, the price of those bonds will also be affected by the rand. So parking your rands in government bonds for a while and then taking out once the rand is stronger is one strategy that you could follow. The other strategy that we actually prefer is to take the money offshore, start investing it offshore, but just hedge it back and unhedge it gradually as the rand strengthens.
Great, Wikus, thanks so much.